Since 2009, UK house prices have increased by over 80%. This has been despite weak economic growth and even poorer growth in median wages. The boom in house prices has been caused by limited supply and ultra-low interest rates. But 2022 has been a turning point for the housing market, with the prospect of higher interest rates causing market conditions to change radically. And with interest rates going up, inflation high, and likelihood of a recession, how much are house prices likely to fall in 2023? Will it be a modest decline, or will it be a big crash like in 1990, 2007? Well, first of all, let us have a look at house price to earnings ratio. This is the ratio of the average house price to average earnings. And you can see that we are reaching record levels, with average house prices over 7 times earnings, which is higher than the peak in 2007 and also in 1990. Now, there's considerable variation between different regions, with London house prices around 11 times earnings, whereas in the north, much more reasonable, around 4.4 times. So on its own, this is a clear indicator that UK house prices are looking overvalued and could be set to fall. However, it's not the only thing that we should look at. In many ways, a better guide is the affordability of housing, which takes into account mortgage payments, especially for first-time buyers. So you can see here that as a share of take-home pay, mortgage payments are not that much above the long-term average. However, all that is going to change quite quickly. If interest rates rise to 5.5%, which is widely predicted, then this calculation changes quite dramatically, and mortgage payments will rise to 45% of take-home pay. And this is a level not seen since just before the crash of 2007, and not that much lower than the peak of 1990. And the interesting thing is, if we go back to 1990, interest rates reached around 15%, and this obviously caused a lot of home repossessions. So now interest rates are much lower at 5.5%, or they could be 5.5%, but the value of mortgages is so much higher because, as you can see, how much house prices have risen. And you'll often hear perhaps the older generation saying, oh, back in my day we survived interest rates of 15%. And they well did, but we shouldn't forget that the present generation face much higher house prices. So although interest rates are lower relatively, the actual mortgage payments are still quite high. So for example, if we took a 25-year mortgage at 2%, you're paying around $1,100 a month. If mortgage rates increase to 6%, then the same mortgage would increase to $1,700 or so. So that's a near $500 or $600 monthly increase in mortgage payments, which clearly changes the whole balance of whether it's affordable and whether potential buyers would want to enter into the market. So already we have seen a marked drop, and a lot of this can be put down to the turmoil of the September mini budget, and Zoopla showed there was a 33% fall in buyers going onto the market. But although this may be an outlier and may recover now that there's more stability in the markets, we can also see how buyer interest has been falling through the summer of 2022 because of the cost of living crisis. So we have high house price to income ratios and also decline in affordability coming very soon. Now, not everybody will be hit straight away, because people on 2-year or 5-year fixed mortgages will not face the higher interest rates until later in either next year or the year after. So there is some time delay. So the fact that house prices have already started to fall last month is an indicator that this trend is likely to continue as interest rates continue to rise and more people have to remortgage at much higher rates. Now, for me, a key factor that will determine the housing market is the state of the economy in 2023. Because if inflation falls, economic growth remains positive, and we get renewed real wage growth, then the fall in house prices might be quite modest, just a small correction. However, for many reasons to be very pessimistic about the UK economy in 2023. Firstly, we are facing a very genuine cost of living crisis. Inflation is far above wages. We're seeing record falls in real wages. And the Resolution Foundation predicts that the worst of the cost of living crisis is going to hit next year. There's a lot of tax rises to come, interest rate increases, and also the prospects for real wage growth is quite limited. Now, if you look at this graph, it shows that the poorest 10% are actually going to be hardest hit by the cost of living crisis. And in a way, they are unlikely to affect the housing market because there's a very limited ability of people on low incomes to actually get a foothold in the housing market. Nevertheless, it is important for two reasons. Firstly, this continued decline in real incomes will depress the economy. It will depress demand and is likely to push the UK into a recession. Also, even middle incomes will be squeezed by tax rises, higher interest rates, and weak wage growth. And so therefore, many will be unable to take out a mortgage or unwilling to take the risk with all the uncertainty. Also, since Rishi Sunak became the Prime Minister, the markets are a lot calmer. Interest rates came down from their crisis peak after the Truss Kwarteng budget. However, it did come at a cost. And whereas before markets were quite relaxed about, say, higher government borrowing, Sunak has come in with the prospect of a renewed austerity drive. So already people are talking about quite substantial tax increases to plug the fiscal hole and further squeezes on government spending. So this is going to be another drag on economic growth. And although interest rates may not rise quite as high as they might have done, the cost is that we will pay through higher taxes and lower spending. So again, this is another factor that will push the economy into a recession and therefore reduce the amount of people who are able and willing to take out a large mortgage. Also, other factors to consider: the whole global economy, and especially the European economy, is facing a real slowdown because of high energy prices, cost of living crisis, and central banks not knowing what to do, high inflation, having to increase interest rates even as we head into a recession. And it's debatable about whether this is a good idea or not, but because the US are increasing interest rates, because the US economy is actually doing better, it really puts pressure on Europe and the UK to increase their interest rates to protect the value of the euro and sterling. So we have this bizarre situation, but as we enter into recession, central banks are still increasing interest rates. So all this is bad news for the housing market. And we have this long-term overvaluation. And the recession and higher interest rates are likely to be that tipping point that really causes prices to fall. And because the market is so different now, it will affect the buy-to-let market and speculators, because the past 13 years have been great for investors who want to buy a house to let, because they benefited from rising prices and also very cheap interest rates to make it cheap to pay for them. But now that this has changed and we face a prospect of falling prices and higher interest rates, many buy-to-let investors may consider selling now, locking in their gains, or at the least not being so keen to buy new houses. So that speculative element could contribute to bigger falls in house prices than perhaps some people predict. Now at this point you may say, well, aren't UK house prices going to remain expensive because of limited demand and growing households? And I think in the very long term, house prices are going to continue to be expensive. We do have this paradox of an increase in the number of households and the political difficulties of building houses to meet that demand. However, in the short term, the higher interest rates are really going to overweigh this, and I predict that there'll be quite a substantial fall in house prices in the next year or two. How important are house prices to the economy? Well, an economist called Edward Lima of the University of California wrote a couple of papers saying the housing market is the business cycle, because there's a very strong link between house prices and the economic cycle. When prices are rising, there's a positive wealth effect, encouraging people to spend. When prices are falling, it creates a collapse in consumer confidence, a fall in household wealth, and it constrains spending. So when house prices do fall, it will contribute to all the downward pressure on economic growth that we're seeing from inflation, higher oil and gas prices, and rising interest rates. So it's an unwelcome combination of factors that are definitely putting downward pressure on the housing market and the economy. But I'd like to go into more detail in a future video on how the housing market affects the economy. This correction in housing markets is a global issue. Some countries like Canada, Sweden, Australia, New Zealand are likely to see even bigger falls in house prices because they became even more overvalued. Anyway, I hope you found this video useful, and if you like it, give it a thumbs up and subscribe to Economics Help. We'll be doing a lot more videos in the future, especially on the housing market, because it's such an interesting topic at the moment, having a big impact on the economy, on households, and also a lot could change in the next few months as the economic situation develops. Thank you. Bye.